I'd say it's a pretty conventional August. You go back through time, and we've had some pretty violent August, but this is, I think, one of the sleepier ones here, where like there's not a ton of new.
The
news,
VIX has
right?
hardly moved. I mean,
Yeah, the VIX is sort of
tendency.
stuck in the mid-teens. We did see it, make a year-to-date low just last week there, but it wasn't much lower there. And the VIX is, I think, kind of behaving reasonably well here. You're seeing some of the tail protection skew, like the bid for tail protection has actually been climbing a little bit here. So look, I think the VIX is sort of at the low end of its range, but it's kind of doing what it's supposed to be doing. I do think, September, of course, is notoriously a lot more volatile.
Yep.
And I think one of the key events here is that we've had two FOMC meetings with Warsh, the June meeting, then the July meeting, very different types of reactions to that meeting. And I think this third meeting is going to be what's absolutely critical. I agree with Ethan Harris that Friday is probably a snooze from Jackson Hole. But I think the September meeting is really going to be in the spotlight. We get dots, we get policy decisions, and most importantly, he's got to really sort of define himself on terms of what his framework is, what his reaction function is, what, to your point, Paul, what data he's going to kind of really be most relevant and salient to his thinking. And of course, there's that sort of boogeyman of Fed independence that has sort of been lingering. And if he can get rid of that cloud and really help tamp down term premium, then I think that will be very effective. If he doesn't do that, then I think it's going to be, you're going to see term premium on bonds expand considerably further.
10-year Treasury 463, the 30-year 517. Are these the new normal, higher for longer levels? Are these kind of the new normal? And if so, what's that mean for everybody else in the world?
Yeah, well, I do think there's one of the things I've been talking a lot about is that there seems to be this sort of like, oh, you look at a chart of the 10-year and it doesn't get through 5%. So as soon as it gets up towards 5%, oh, you can buy that and stop worrying about a bond market unraveling. One of the points I've been making is that this bond sell-off is decidedly different than the ones we saw from 2022 to 2025, where you did see that ceiling come into play. And there's a couple of things there going on, one of which is that the Fed policy was really in very restrictive territory during those sell-offs, right? Now we're not. Now we're either, depending on how you look at it, either neutral or accommodative. The second thing is that inflation was receding from record levels there. And so the bond bear back during those sell-offs was swimming against two key structural tides. One, Fed policy needing to normalize, and two, inflation needing to normalize. Those things have really kind of normalized now. So now the risk is much more bidirectional. And I think that for that reason, the 5% target, 5% ceiling rather, is not such a hard ceiling. And the other dimension, Tom, is that the volatility on the 10-year Treasury note is one half of today, what it was back during those sell-offs. This is a quiet, sort of creeping sell-off. And I think it's not as dramatic.
Right.
But it is also probably stickier.
So people that own stocks, whether they're retirement plan, they're barbelled and laddered muni bond maturities like Paul Sweeney, people in conventional investments just keep on keeping on, right?
I think so. And I think there's a question I felt like you were about to ask me, which is that, okay, well, what level, in the 10-year, is it 5%, 5.5%? Does the equity market start really having problems? And I guess my view on that is that the equity bear case in 2026 comes down to, will earnings be disrupted by higher interest rates in a meaningful way? And I don't really see that as a case, right? As the equity question really comes down to the earnings question. I see earnings as being it's been an incredible year for earnings. I think it sounds like a little bit of a hyperbole, but I think the earnings condition we're living through right now is absolutely historic. It's really unique. And we're all kind of like, okay, well, it's like, year 4 of a bull trend, and we're all kind of tired in a way of it. We're all like liking it in the 401k, but we're all kind of like, oh, this doesn't feel right and all that kind of stuff. But when you step back and you look at what's happening to earnings growth, it's truly exceptional. And if, it's not really the valuation is right now we're sort of in the middle of our longer term trading range here. And Tom, we talked about this last time I was on, but the concept of 9,000 at the year end is not it sounds insane, but it's really not that insane. If you just simply look at forward earnings growth per Bloomberg consensus has been rising on average 3% a month, right? So if you
Listen,
just 3% a month.
I was going to say goodbye, but you deserve one more question after 9. I'm awake now. Well, I was here with 9,000.
Well, no, it's just simple. It's fourth grade arithmetic. But if you take 21, 22 times and you keep scrolling out 2% a month earnings growth, take a discount there, right? 2% through the end of the year, and you don't see anything bad on the horizon in 2027, then the market could easily melt up to the high 8s or even the low 9s there.
So to the extent we have a slowing growth rate in 27, because you can't keep up the 30% number, what does that mean for the market if you come in with a more pedestrian 12% earnings growth next year?
Look, I think if it's still 12%, that's pretty darn compelling.
Yep.
And I think, look, right now, I think after Q1, we had this huge surge in earnings beats and upward revisions. Then you look at the Q2 earnings beats; those were much better than the Q1 earnings beats, right? Yep. I mean, we have had the highest beat records on record. We're talking about margin expansion across most sectors that is, really remarkable, right? So, we could talk about a tech-weighted market here, but even if you look at it on an equally weighted basis, margins are performing. Top line is growing in a higher nominal GDP condition. It's also, I think, an underappreciated fact that, look, the world's economies are doing pretty good to well, right? It's not just a U.S.-centric story, and so that helps reinforce S&P earnings as well.